Yesterday we're talking about Opendoor after a Thursday session that looked rough on the surface but might actually be setting the stage for an interesting Friday pre-market setup. The stock closed the day at $8.56, down about 8.6%, and then slid a little further in after-hours trading to around $8.34. At first glance, that looks like Opendoor losing momentum after a strong week. But when you zoom out and layer in the full context of the market, the catalysts coming up, the macro environment, the insider behavior, and the psychology of short sellers heading into the Warrant dividend record date, this dip begins to look a lot less like a red flag and a lot more like natural volatility inside a broader bullish setup. Markets today were sharply down across the board. Tech was heavy, housing was heavy, and pretty much everything outside of defensive sectors saw pressure. So when you see Opendoor take a hit on a day like this, you can't treat that move the same way you would treat a sell-off in isolation. The question isn't why did Opendoor go down today? The real question is whether anything structural has changed about the company, the catalysts we've been watching, or the behavior of the market in response to those catalysts. And at this stage, nothing about Thursday's move reflects new negative information or a breakdown in belief. If anything, the underlying setup continues to strengthen. Let's start with the most immediate factor, the upcoming warrant dividend. Shareholders of record on the 18th of November are set to receive three types of warrants, the Series K, Series A, and Series Z. Yes, they literally spell KAZ, which is either the greatest coincidence in financial history or a subtle show of confidence from leadership. Whether it was intentional or not, the psychology around this has become a story in itself. Retail loves symbolism, and institutions pay attention when incentives are lined up in ways that keep shareholders holding and short sweating. The warrant dividend does exactly that. If you're a long-term shareholder, these warrants represent optionality, leverage, and a reward for staying the course. If you're a short seller, the opposite is true. You have to cover the economic equivalent of that dividend. It becomes more expensive to stay short the closer you get to the record date. Some shorts will choose to ride it out and see if they can hold through the dividend and hope for downward pressure afterwards. But a lot won't. A lot will simply decide that the risk isn't worth the reward. And if you're a short facing this kind of situation, and the stock has had 4 straight green days before a down market finally gives you a breather, you take the breather. You reduce exposure. You reposition. That's why today's move is not concerning. It plays into the psychology of a stock heading into a period of structural pressure for shorts. And that's before we factor in the CEO's behavior. Kaz Nejatian made a roughly $1 million insider purchase of Opendoor stock earlier this week, his first opportunity to buy since becoming CEO. That is not small. That is not symbolic. That is not a gesture. That is a man putting $1 million of his own money on the table at the very moment Opendoor is trying to pivot into a new chapter. People love to talk about alignment between leadership and shareholders, but buying stock at market price is the strongest real-world signal you can send. Kaz is not guessing. He's not dabbling. He's not waiting for stock options. He bought shares the same way every other retail investor does, at the same price, in the same market, at the same risk. And that carries weight, especially for institutions watching from the sidelines. So you have a CEO putting his own capital into the business. You have a warrant dividend that incentivizes long-term holding and creates pressure for shorts. You have a record date coming up that could tighten the float. And you have a stock that just came off several days of strong upward movement. When a stock like that pulls back on a red day for the entire market, that is rarely a sign of weakness. More often than not, it's consolidation. It's breathing room. It's the market resetting before the next move. And when you look at the behavior of buyers this week, the psychology definitely leans toward consolidation rather than weakness. On top of that, we also need to consider the macro environment. The latest jobs data has increased the probability of a rate cut in the next period. Markets were heavy today because traders are repositioning, adjusting exposure, and figuring out how to price shifting expectations. When markets reprice large macro shifts, there is turbulence. But here's the key difference. Unlike a lot of tech and growth names that simply sold off because their valuations were stretched, Opendoor actually benefits from lower interest rates. Housing liquidity improves. Transaction volume increases. Pricing becomes more efficient. And mortgage affordability improves. Opendoor, as a marketplace-style liquidity provider, thrives when the housing market loosens up. The rally we saw earlier in the week was partly tied to those macro expectations. So the pullback today is just the other side of that macro volatility. Nothing in the long-term picture changed. Now we have to talk about the psychology of the market itself heading into Friday. 4 green days, followed by a red day, especially on a heavy market, is not just normal, it's healthy. It prevents parabolic blow-offs, which are usually followed by violent corrections. This kind of ebb and flow creates stability. And stability is exactly what you want heading into a record date where the stock needs to hold its footing in order for the squeeze dynamics to stay intact. There's also growing chatter online about the possibility of a short squeeze, and while it's always dangerous to declare any stock as a guaranteed squeeze, the ingredients are definitely there. High short interest, tightening float, a hard record date on the horizon, insider buying, increasing retail interest, a macro backdrop that is shifting in Opendoor's favor, and psychological pressure building for shorts who have already seen this stock move from under $5 to over $9 in a matter of days. Another factor to consider is Eric Jackson's long-term thesis. Eric has been outside Drake's for 80-plus days now, symbolically campaigning for this stock to be recognized the way Tesla was recognized early in its life. His $82 target price is bold, almost outrageous to some, but that's exactly the point. Visionaries are not subtle. And whether you agree with his target or not, it keeps the long-term narrative alive. People listening understand that Opendoor's real story is not about this week or next week. It's about the structural shift in housing liquidity over the next 3 to 5 years. And bullish narratives take on a life of their own when the macro story, the short seller pressure, and the insider alignment all begin to stack on the same side. So as we head into Friday's pre-market, the story is not that Opendoor dropped 8%. The story is that Opendoor held up better than the broader market on a heavy day, that the structural catalysts are still intact, that the warrant record date is approaching, that short sellers are in a pressure cooker, that the CEO is buying shares, and that dip buyers may see this as a chance to position ahead of the 18th of November. If you're looking for a video angle heading into Friday morning, the theme is simple. This was a dip, not a derailment. A moment to breathe, not a break in the trend. A chance for new buyers to position themselves, not a sign that belief has weakened. And the core message for Friday pre-market is this: with the record date coming, with the short interest high, with the CEO buying, and with the macro wind finally blowing in Opendoor's favor, this dip might actually be the most interesting moment of the entire week. Because it's during dips, not rallies, that real conviction reveals itself.